organization and how the current situation, the environment, the financial situation, what impact does it have on our day-to-day life? We have with us the CEO of Oliver POS, Mathias Nielsen. And what's really interesting, it has been noted in the media recently that Oliver POS had raised over $3 million. We're going to have an opportunity to talk to Mathias how he was able to accomplish that in spite of the current financial circumstance of the COVID-19 pandemic. So my name is Wayne Brown. I'm the managing partner of the Walker Group. We are a fintech boutique consulting company that sits in between or at the intersection between fintech and financial organizations, and we really help fintechs partner with banks today. And I'd like to introduce the panel. I'd like to start with you, Ross. Can you introduce yourself and what your day-to-day role consists of?
Sure, absolutely. Hello, everybody. My name is Ross Pitkoff. I'm the owner of Ross Pitkoff Law. We are a company representation and corporate and litigation law firm located in New York City. The practice revolves around working with all types of businesses, including startups, to get their companies properly set up, get them properly registered, help them and assist them with the capital raising process, and also represent their interests.
Thank you. Thank you. Buck, would you like to introduce yourself and what you do?
Sure, thank you. Hello, everyone. I'm Buck Kulkarni. I'm the founder and CEO of Startosphere, which is my little effort to help startups all over the world with product management, road mapping, preparing for acquisition of large customers, regulatory compliance, due diligence for getting more funding. So that's what I do for a living. And of course, BFSITechTalks is one of my more passionate projects with Wayne and Ross, where we come together from time to time to bring experts who have accomplished, great deal of things in the startup world and share their experience for our community that can help all of us learn how we can do better.
Thank you. And that really brings us to our guest, Mathias Nielsen, who's the CEO and founder of Oliver POS. Mathias, would you like to introduce yourself and then provide a little bit of background about Oliver POS, and then we can go right into some of the questions that we have for you and also the panel in general.
Absolutely. So hey everyone, my name is Mathias Nielsen. I'm originally from Denmark, hence the North European accent. So I'm also the founder and CEO of Oliver POS, and we help empower small business owners by allowing them access to the same kind of POS tools that much bigger corporations would have. So yeah, that's
perfect. Perfect. So Mathias, we're going to go right into our questions for you. So obviously, you made the decision to raise funds during the COVID-19 pandemic. Can you talk a little bit about why you made that decision in view of one of a time like this where there's so many financial and economic challenges?
Yeah, absolutely. So and I've probably been one of the ones saying it's important to bootstrap and hold on and not sell too early until you have validated your idea a little bit more. And we've been doing that actually. So we've been bootstrapping pretty hard, but proudly being bootstrapped up until we were just about 2 years old. Bootstrapping, figuring out what we were actually doing, who we were selling to, all that kind of things. And then suddenly the pandemic happened, and we're sitting with a bootstrapping budget where we had actually just landed a $1 million client that basically canceled out on us overnight. And at that point we knew, okay, now is the time. We're no longer bootstrapping. We need the money to accelerate this much further and go into what we call hypergrowth. So the second I found out, okay, pandemic is coming. We already have a good product. We're proud of what we are. No more bootstrapping. Over to the hypergrowth that we already knew we wanted for a long time, but wasn't ready for until basically when that happened. So yeah, that was kind of the reason why we suddenly jumped into it and raised in a matter of maximum 2.5 months from beginning the talks to check around this.
Okay, thank you. And can you tell us how much? Obviously, we know. For those who don't know, how much did you raise during this time? And is there any specific process that you followed in order to accomplish this?
Yeah, so we raised $3.2 million, And I think the part of the explanation that came before of bootstrapping is also the reason why we could raise a big amount as an early startup, but we really knew who we were, which is why we could ask maybe a little bit more than most startups do. I know we were 5.5 times above average in Atlantic Canada. So yeah, I think a lot of the reasons why we asked for the 3.2 and not 600,000 or whatever an average would do is we knew a lot about ourselves. We already knew there was a pie. We just sold a little piece that we knew would be a lot bigger. So all of the money here is really going into funding growth and not development of the product.
Oh, okay, interesting. Thank you. I'm sure the audience would like to know if there were any roadblocks or challenges that you had. I mean, obviously 2 months, 2.5 months is a relatively short time to raise that amount of money. But did you foresee any roadblocks at the beginning? Did you foresee any challenges? And if so, is there anything that you can give some advice on how you kind of circumvented that, or maybe no challenges at all?
Oh, there's plenty of challenges, and there's always, I kind of think, as a startup founder. For us, it was really, we weren't really ready to raise at the time. So we had to get a lot of our legal documentations, our minute books and everything fully up to date before even being ready for an investor. And at the same time, a lot of the investment companies that we had been talking to, we probably were in the talks with 10, 11 different companies. A lot of them were insecure about their future and the world's future in many ways. So they were canceling out on us. And what we found is they were really not understanding the business model for us. We got hurt through COVID as well in the sales of Oliver POS, but we knew that what is going to happen is most businesses switch to an online model, which that's where we live. We live as an online POS solution, right? So for us, we started digging for other types of investors that could see where we were heading and that it would be beneficial for all shops affected by the pandemic after the big hit had been there. So yeah, a lot of the blockers were in investors canceling out, and we started finding others. And then we were really selective in our process as well. I wanted to find a strategic investor in many ways that were there to advise us and help us on the way as well. So, but I think we succeeded with that.
Good. So one question came from the audience with regards to the equity that you gave up. Are you comfortable to mention what equity or range or whatever you feel comfortable with sharing about that?
Yeah, like I'm not allowed to say the precise equity, but for 3.2 million for startup, it is of course a chunk. I think it's a lot less than what people would expect for that. And the reason is, again, we've proven traction. We knew that we could handle many merchants a day and stuff like that. So we didn't have to give up our soul and everything. And it's not your typical investor in that regard as well. So we're extremely happy with the deal. It couldn't have been better.
Great. We're going to turn some other questions over to our panel. I know, Buck, you had some questions from Mathias with regards to a little bit about his Jerry Pond Award.
Sure. Thanks, Wayne. So, Mathias, what I want to do is go back, behind the scenes a little bit, so that people start to see, what went into, because getting good funding is a milestone that everyone notices, but there is so much behind that before you reach that stage. And I want to ask you a little bit about that. So, you were some of your decisions, which were not something that very young startup would do, like embracing open source platform as your foundation, adopting, offshoring partners right from the get-go, which is a very courageous thing to do. And also I want to ask you a little bit about the Jerry Pond Award that you won so early in your life cycle. So if these 2 or 3 things, if you can share a little bit with your audience, that would be great.
Yeah, absolutely. So if we talk about the first thing, we've been built from the beginning and from scratch really to be an international product, a global product that will really sell in every part of the world. And what that comes with a lot of heavy challenges that most companies would probably not embrace until much further in their life cycle. Most startups take and find a niche market and niche maybe one country where that's what we want to own. We really wanted to take it from the beginning and think global. And therefore, our solution is built with handling any currency in the world, any language in the world, any tax rate, stuff like that. So we've really had a lot of those very heavy duty challenges from the beginning. But what that also means is we can go this hybrid growth of adding customers from everywhere in the world with I think we're in 80 some countries now, and adding every day, I would say. So yeah, we've been targeting going global from the beginning. That was a big mindset, and it's also why we're on this major open source platform that we work extremely well with. It's because we're global, so that's how we're able to handle everything as well, right? And then we unlock the powers of other developers. We know we won't be the only ones that have to develop all code. So we're unlocking a million plus developers in the world to help build our platform as it is, so they can help shape the new world of the POS industry.
Thank you, Mathias. I'm just going to add a little bit for our participants.
Yeah.
You know, some of these things that we learned from Mathias and what Oliver POS is doing is that even if we are starting very small, make sure that the platform that you're thinking of is scalable. And it's not scalable just in terms of cloud and this and that, but the architecture itself. Are you adopting the right components that are capable of growing? Are you adopting or developing a proper ecosystem of vendors and partners that can help you ramp up quickly? So these are some of the important points that I learned from what Mathias is explaining to us. Thank you, Mathias. And if you can move on to the Jerry Pond Award, what you did for that.
Yeah.
But I want people to know that, you know, participating in competitions, winning awards is not something that you start doing after you have grown. It is something that you start doing right away.
Yeah, no, absolutely, and I'll say that that's a big part of our race and our valuation as well. Is we've been cognizant of finding the right mentors behind the company, behind me, that I can always grab the phone and call. And I would probably say they've helped bump up our valuation quite a bit as well by advising us, finding other investors that they knew that was interested at the same time, which creates some good competition between the investors as well. But yeah, the Jerry Pond Award was really, we were part of a great little accelerator called Propel ICT. And at the end of the accelerator, they give an award and with money and a couple of other things at the end of it. And we managed to have pretty crazy growth over those months we were with them. I think the sales numbers was something like 4,500% increase during the period, and yeah, I think that was a major reason why we won it, and also that we were really built with this global level that most founders don't start with, but from previous experience, I just knew that's what I wanted this time around. So.
You know, I have a quick question for you, Mathias. Two questions, really. For those of the audience who are not familiar with the Jerry Pond Award, I'm sure they're kind of baffled. Okay, what is the Jerry Pond Award? Can you talk a little bit about what that award is for those who may not be aware of? Because certainly that, you know, as people are thinking about that, as startups and those stakeholders to the industry, that might be something that may be available for them as well.
Absolutely, and I would encourage anybody to reach out to Propel or to any accelerator or incubator in their area. Sometimes they're great, sometimes they're not, but I would really advise everyone to research everything what is around them, and see if it's a good fit, because like if you do good and you're smart about it, I think there's a lot of awards out there. The Jerry Pond Award is really one that is for Canadians, but yeah, it's a great award from a business owner that have been doing a lot of different enterprises very successfully, and started an award to help other small startup founders get started, right? And it comes with money and investment opportunities and all kind of stuff, right? So
excellent. There's a question from the audience, from one of the attendees, and here's the question. It's to you, Mathias.
Yeah.
As a global company, there are so many factors. Did the global nature of your business attract investors, or make you nervous and scare them off? Or make them nervous and scare them off? That's one of the questions. Obviously, because again, in view of all the things that are happening around the world.
Absolutely, it definitely scares off some. But I would venture to say they're probably not the right investors for us then. So it all happened, like it's all about finding the right investors. the investors we have behind us believe in the global and are not afraid of it. They've all three behind us have been building international companies and global companies themselves. So they're not afraid of it and would probably go the way we have gone after the fact. Most companies again start in one place and then try and grow from there. The three ones we have behind us with all trust in the way we're going about it. It's much harder to get started, but they're also buying in now that we have figured the majority of the challenges of being global out. There's always new upcoming, of course, but yeah, the market is also so much bigger, right? So.
Yeah. This is great. We have some more questions from the audience, but we're going to pause for a little bit and we're going to talk to Ross. And we're going to kind of look at this from a very general perspective about raising funds and some of the obstacles just in general that especially in the United States, some challenges that are here. Ross, in your experience, what are the biggest obstacles that you see founders face when they start to see capital in the United States?
Sure. Well, after working with a number of different companies in the startup space, I think a lot of the biggest obstacles often do take place during that first round of investment. I think it often is difficult because it involves a lot of risk, and typically you have the least experience with your product or idea. Therefore, there's sort of this lack of extensive trust in the marketplace unless your name is very well known. And I think even then, you still have to prove to your investors and show that your product can work and that it can be successful. And they're really going to be taking a bet on that in the marketplace. So, maybe some keys early on, which are really the obstacles to overcome, is I'd say number one, learn to be patient. Understand that things take time to develop. And unless it's a close friend or family member that's investing, you're probably not getting an investment overnight. I know Mathias mentioned about, a 3-month period, which to me, I think is a very good period, an impressive period from getting to due diligence to close. But recognizing that a startup early on should allocate their funds accordingly so they really don't run out of funds too soon. Mm-hmm. Number two, I'd say properly leverage your relationships from day one. So I've worked with some companies that don't really have their digital marketing set up. They don't really have an email marketing system in place. They're not holding informational events or sending physical mailings. And then when they're finally ready to raise capital, the delay that they didn't anticipate is there simply because they weren't staying top of mind and offering consistent value. So I think, ensuring that while they're growing the business, they're also maintaining those relationships is imperative. And number three really comes through the legal lens, and that's to make sure your company is prepared for the due diligence process. And I'm sure, Mathias, you can relate to that. It sounds like you touched upon that. And areas to focus on there: is your company properly set up and structured for investments? Are your vendor contracts in place? Have all of your employees signed employment agreements and non-disclosures? Are your financial records organized? Do you have a solidified organizational structure? Is there a clear management team with processes and systems in place? You had mentioned, board minutes. Do you have those? Are they actually written down and are they actually organized the way they should be? And do you have skeletons in the closet? Previous litigations or disputes that could become public in the near future. I've worked with companies that sort of want to say, well, we don't want to let them know that there's a pending litigation in federal court or in state court. And sometimes just because it doesn't come up in a Google search, they think they can kind of avoid disclosing this. The answer is always no, because it's going to come up. And my recommendation always is that you should acknowledge it, disclose it, explain what happened, and then be in a position to say what you've changed internally to ensure that something like this isn't going to happen again.
Mm-hmm. And very interesting. So again, Ross, we all hear about the exceptions from registering and offering with the SEC, and understanding that most founders will look to raise capital without first registering with the SEC. Can you provide us with an understanding of what exactly the registration exemptions are and how to ensure compliance in this regard?
Sure. So generally speaking, this can be a very long response, so I'll make sure to keep it to the nuts and bolts. Securities, typically the sale of securities in the United States need to be registered with the Securities and Exchange Commission. There are certain exemptions that you can qualify for under the Securities Act. If you don't qualify for one, then you have to enter into a very tedious, arduous, and expensive process of registration. And that includes providing a description of the company's properties and business assets, a description of the securities that you're offering, information about the management of the company, and the most often expensive portion are providing certified financial statements from independent accountants. So thankfully, to avoid this process, most startups are able to register or to raise capital, through one of the exemptions under Regulation D of the Securities Act. And that usually comes through an offering under Rules 504, 505, or 506. 90% of the time, the registrations exemptions are able to be utilized through Rule 506B or C. And in order to comply with the Reg D exempt filing, you do have to do a few things. So number one is you still have to file what's called a Form D with the SEC after you first sell securities. Form D is a very brief notice. It includes the names and addresses of the company's promoters, executives and officers, and some details about the offering itself. That's generally it. So it's a lot less detailed than what otherwise would need to be filed. Then you need to provide certain disclosures to your investors and, very importantly, avoid violating the anti-fraud provisions of the security laws. So when people hear about private placement memorandums, that's typically what we're talking about. Those are documents that provide, detailed information about the company itself, what investors need to be mindful of, and of course, they need to set forth that information in a way that isn't fraudulent. And that also includes avoiding any withholding information that otherwise puts the company in a position where if you're withholding information that's important to an investor, you're going to be considered to have violated those anti-fraud provisions, such as the board of directors and the officers of the company are being indicted because they're laundering money through the company. That's a major problem, probably would have to be disclosed, but of course that type of business probably wouldn't be raising capital anyway. Then number three is you have to adhere to rules concerning solicitation and the types of investors who can invest. So for example, just using Rule 506 as an example, 506B basically states that a company can sell securities to an unlimited number of accredited investors and up to 35 non-accredited investors. However, general solicitations to the public aren't allowed, and you either need to make this offering through a registered broker-dealer, for example, or know the investor prior to your raise. Contrast that with Rule 506C, which is a creature of the Jobs Act, and that allows for general solicitation to the public, but all of the investors have to be accredited. So the benefit there is you can solicit to whomever you want, but you can only accept the investments from those that are accredited. So quick recap, you gotta file Form D as part of an exemption. You have to adhere to disclosure requirements and avoid violating anti-fraud provisions of the securities laws. And then you need to use the proper exemption that aligns with who you wish to promote your investment to and which type of investors you can receive an investment from.
Well, the reality is it's not an easy task. None of this seems to be easy in detail. Let's talk to Buck a little bit, because Buck, you bring in a very unique perspective with startups in general, and especially those that are looking to raise money, and what you have seen. Will you talk a little bit about the changes that you've seen in the audit and compliance function of financial services sector due to the pandemic in general?
Oh, absolutely. That is something that has become a huge issue last couple of months. Even big companies are worried. Startups, if they have got a financial services customer, then they are worried a lot too. Because what's happening is, all of us know that work from home over the last 6 months, and most companies, including some very large companies, banks, and other people, do not have a formal policy for controlling the work from home. So whose computer is getting used? Is it a company issued computer, or somebody can use a personal computer and laptop to do company work? Right from there to all kinds of things, VPN and encryption, and it gets more and more and more. And the bottom line is, while this is going on the other side, ransomware has picked up a lot, because you can imagine that these provide entry points to, the bad guys, with all people, doing, people don't realize, I'm not talking about, confidential work and architectures and drawings and stuff like that. I'm talking about people using a Zoom or a Microsoft Teams meeting, to review their SAP accounting screens. Just imagine the kind of risk that is getting taken here.
Yeah.
And this is serious, and ransomware is something that I'm already seeing the Big Four and other auditors that I work with very, very focused on now. So expect this year and next year, ransomware, your presence on your data being available on the dark web, all these issues are going to acquire a lot bigger, face in the coming months. And if startups, fintechs are not ready, then I know it's hard to say that because they don't have the resources, they don't have the expertise. But the problem is, if you are selling to a credit union, if you are selling to a bank, if you are selling to an insurance company, you have no choice but to comply, because the regulation in principle, the regulation is the same for you and Bank of America. That's how you must look at it.
Very good. Yeah, no, interesting points. Mathias, we're going to go back to you. Obviously, with regards to the raising of funds, especially during this time, you're looking at the strategic growth of your company, obviously, and this amount of money is probably to really help you with the growth of your company. So what are your plans for growth during this time? And obviously, despite the pandemic, you have a clear vision that you're executing against. So could you share some thoughts strategically of what you're looking to do and move forward, and what your vision is?
Yeah, absolutely. So we're definitely not slowing down for any pandemic. We don't have time for that. But yeah, like there's going to be, of course, a lot of customer acquisitions and stuff like that going on now. We're growing heavily in many different countries. Some new countries are coming up for us in Africa and India and stuff like that. So that's very exciting. And then we're gonna, I can't talk too much about it, but we're trying to move into the payment space as well, really, where we want to be able to offer payments with our point of sale solution as well. So we've really always looked at ourselves as a retail tech, or a fintech hidden as a retail tech, where we're going to be in the payment space. We have 58.8% of our customer base really want us to service them with payment solutions as well. So that's something we're working a lot with, which is where it's very interesting to hear a lot about the regulations and stuff like that we're getting into now. But yeah, big growth plans. Yeah.
Okay, good. There's a number of attendees that are on our webinar that are fintech connected. They are running a fintech. They are working with a fintech. And some continue, and in general, as we see in the media, are dealing with challenges in their day-to-day to accomplish the things that they need to do. What advice or steps do you suggest that companies take when seeking to raise funds, especially in these times?
Yeah, so first thing I would say to that is raising funds shouldn't be a goal in itself until you can see that it's necessary to grow your user base or whatever it is that makes sense. Don't raise to just develop the product further. Raise when you have the product, and then raise heavily so you have enough to spend to go out and do acquisitions or mergers with other companies, or going out getting your customer base so much bigger that when you need to raise again, it's on a different level. I think I've done this mistake myself when I lived in China. We started a startup and we took all the money in and we spent it all on product. And it was probably a big, I know it was a big mistake from our perspective. First of all, it gives you a very low valuation. Second of all, when you raise with that valuation, when you go to raise again, you can only 5-6 times or whatever the amount you raised for the same your valuation. So it's very, very big, as Ross also mentioned. Figuring out the first one is really key to where you see yourself in 10 years or wherever. The first raise really matters in my book. So don't stress over just to rush to get the first round. It's not important until the game of raising to get more customers and whatnot really first starts once you get the first round. So be prepared for when you take that round and make sure you're ready for the scale, because it will just hurt you. And I'm talking from a lot of experience in my previous companies there. So with raising, if you've done what I just suggested, you would know when it's time to raise. I actually think you have your product, you have a couple of solid customers that says this is good. You need to build more. You need to do this and this. Then we'll really love it. And then you'll know when you're ready for raise to raise the first round. But I would rather, like, I've done part-time jobs. I've done everything that we didn't want to do in order not to raise until we were ready. But then raising can be an amazing thing when you really feel like we just need money and then there's going to be a big boom. Then raise and go full on in it. And I kind of used the pandemic. I was the only one in this office building here coming to work at the beginning of the pandemic. So I saw my opportunity to get some some freedom to just focus on racing. And actually, that's a big reason why we got to race as well. Block yourself out and don't do anything but that. Investor meetings every day. I think I chatted with investors 3 weeks every day in a row, weekends, everything, until they were satisfied. Which is also why a race and doing the diligence can take so long time. But it's because you have all kind of other stuff. But we knew that's where we need to go. We'll go in hyper growth mode the second we have it. There's no blockers for us as we look at it. So yeah, don't stress about racing until you know that racing will speed up your business equally.
No, we appreciate that. And just for the audience, we're going to about 10 more minutes of questions that I'm raising as the moderator, and then we're going to open up to the discussion to the participants. They may have some specific questions for you. So we're going to come back to you later, Mathias, but we're going to go to Buck. Buck, you have an observation or question that you want to raise, and I want to make sure that you're able to get your thoughts across on governance and what you feel are connected to startups.
In fact, I want to first add a little bit to what Mathias just explained, from my conversations earlier with him and my own experiences. One thing is, oftentimes this due diligence is seen as a one-way process by most, entrepreneurs, that the investor is doing due diligence on you. But what is equally important is that you also perform due diligence on the investor. Most people miss that. But like Mathias explained a few points, what he was looking for, when he wanted to do that. And a few more points I will quickly add before moving on to my question to Mathias. One is, do you need debt or do you need equity? That you must think very hard.
Yeah.
If you get any money is not good enough. If you take equity in place of debt, you are in trouble. If you get debt in place of equity, you are in trouble. So I see a big smile on Mathias's face.
This is definitely cheaper in the long run, right? If you can handle it. But we took on some debt before racing because we weren't ready to race. We just knew it. So we took a small loan. We got zero interest rate, which is something every Canadian at least can take, and absolutely worth it. We've now been ready to pay that back. Since we got the investment, we're going to do it here shortly.
And the second point is, who is your ideal investor? You need to think a lot about it. I see so many companies every day. They will get money from, let us say, for example, AWS, Amazon. And what they do is all on Microsoft Azure. And I'm giving a very high level example, but there are so many variations of this. And down the road, it becomes so hard for you to, align your work to your investor. So think a lot about who is your right investor. Just don't go because one is willing to put in money. And that's all I wanted to add, a couple of points, but I will move on to my question to Mathias now, is that, typical young entrepreneurs, many times it's like, and in large companies also, we see it every day that if it is not grown here, then it is not going to work. That's one big psychology people have, that they must do everything themselves. And whereas you have done, and I would like you to explain, share your insights with people. One is, like we discussed earlier, adoption of a, open source platform that is equally available to everybody else in the world. So they can compete with you theoretically. They can compete with you more easily because you are not bringing some proprietary, confidential kind of technology. And the second thing is, you early on adopted outsourcing development partners and maintenance partners, whereas a lot of people don't have that confidence. So how did you work on these things? How did you explain to your team why we need to do outsourcing, why we need to depend on vendors? How did you go about it?
Yeah, so good question. It comes back to the same original mindset of we want to be global. We want to be a big thing, and we're living in a small city in Atlantic Canada, and there's only so many IT talents, only so many this and that here, and there's a big competition for them from other companies as well. We knew that by bootstrapping, well, we can't afford to pay $200,000 a year for every developer. That's just not feasible, or was not at least for us. So by doing this mindset of going globally, we knew that we're going to have worldwide support as well. So we have a lot of customers from, for example, in India or Australia or wherever. So for us, it was just like, this is the right step. To work with it, that's a hard thing. It's something we've been working every single day on. I chat with our team that is actually bigger now. We have a big team in India. It's our own office. I fly there normally four times a year. And yeah, they're probably my best friends today. Like we talk every day, 2-3 hours every morning. And like we see it as one of our biggest powers behind us. We can add, like we have the power of India behind us, and we're very thoughtful in our selection of developers and stuff. But yeah, we can hire 10 more developers tomorrow, and there's people that need that, and we can get them in, train them up, everything, and then we do the support and marketing and data science and whatever else we do here. So we're kind of split up in those two offices, and now also sales office in Europe. So yeah.
So if you have to add scalability, if you have to be able to move quickly, then you must have an open mindset of working with partners rather than trying to do everything yourself.
Absolutely. Yeah.
That's very important. Very important.
Yeah, then trust them. Give them all the trust in the world, because I've given a couple of shares actually to a couple of percent of shares to the two leaders that are running the department over there. And this is their own brainchild in many ways as well. They're constantly reinventing, doing better, improving our solution, and are making sure that the culture is the right fit, that we treat our employees the way we want to treat them in a good manner. And like we've been very thoughtful about finding the right ones to work with there. And now they're us. We're the same. We pay the electricity bill together, right? Like everything is done together. So yeah.
This is great. Thank you, Mathias. This is a big insight point. And I'm going to add 2 points very quickly. One is, if you are a technologist yourself as an entrepreneur, you might make a big mistake of, what is called as resume-driven development. That means whatever is there on your resume, that's what you start using for developing your software, right? If you've done Java, then you use Java. If you've done .NET, you do .NET. So that's a big mistake, because your product may require something else. And if you're not a technocrat, then the big mistake that can happen is a vendor can tell you what you should adopt. And if you don't know enough, you'll simply go with it. And that particular technology stack may actually become a liability for you a couple of years down the road. So that is where developing good partners, taking good advice is something that I think all entrepreneurs should keep in mind, even before they actually set up their company.
Thank you. These are good points. We have a question from our participants, and we would like to invite them to continue with providing questions. This certainly helps to create a very interactive discussion. So we have a question, and this question is to you, Mathias. And here's as a quote: "I'd love to hear more about the importance of getting your name out there and having a marketing footprint as a predecessor to raising money." And that subject is obviously very near and dear to me, from how marketing does relate, what you did and how you did it with regards to raising money. Would you like to talk a little bit about that?
Yeah,
very good question. Thank you.
There's many interesting ways of figuring out how to get yours out to the investors you're looking at. It was actually during Propel, I heard a pretty interesting, very sneaky and different way of reaching out. We didn't have a very big budget at the time, and didn't really. We had 1 or 2 persons working, one part-time, one full-time, working in marketing, and we were busy getting our footprint out to our customers, because that's really. And I can tell you and look everybody in the eyes, once you're successful, I promise you that there's going to be, I think we have 5 investors a week at least reaching out to us, and they started before the other investors came. And the key is we were branding ourselves out there and stuff. But one sneaky way, that once we knew these are the investors we really want, there's ways of targeting them very directly, or their wives, so they come home and chat. And what is this Oliver POS? I see it all the time and whatnot. There's so many ways on a cheap budget to bootstrap and make sure that you get seen to only the people you want to be seen by. So we figured out these are the investors we want to work with, and they heard about us every single day, many times a day, if they were going on social media, Google, anything like that. So we were extremely focused on which ones we wanted, and then they would hear us every day without needing to talk with us. They would see social media campaigns, everything, and they know that and are laughing about it today. But we just started saying that's who we want. Let them see us all the time. They shouldn't be able to forget us, and that's how we used marketing. The rest was just in Canada, you say the proof is in the pudding, and it's really here. It's for us. We just try to focus on the product. But once we had the investors, we heavily targeted them.
Good. And if there's any other questions about that, we look for the audience, the panel, the participants to raise that. I think that's a good start to that question. So Ross, I see that you're thinking of something. You want to add to that, or some thoughts that you have with regards to some questions and some thoughts that you have from a legal perspective in raising money, or anything else?
Sure. I mean, from a legal perspective, it's always important to be mindful of, the types of solicitations that are proper, which really depends on the way that you're going to be conducting your raise. But I thought Mathias mentioned some really potent points, and what I've seen through clients that I've worked with is, especially on low budgets, the power of the digital platform, social media. I've seen various businesses join Facebook groups or LinkedIn groups and consistently post about their content, about what they're doing, and they've wound up entering into communications and gaining investments that way. I know another trick is LinkedIn Sales Navigator is used by clients of mine that are able to hyper-target the industries and the audiences that they want to appear before, and they'll start connecting with industry leaders or executives for particular businesses, hedge funds, iBanks, whatever it may be. So I found that, based on what I've seen, to be a very strong way of figuring out, the ways that you can start communicating with the people you want to, or at least start getting their attention, even if you don't have that budget to start spending, thousands of dollars a month on traditional marketing.
Oh, real good question. Another question for you, Ross, is what should founders be most mindful of when deciding whether to accept an investment in exchange for equity?
Sure. Well, that's quite a question. I'd say first and foremost, understand what you're giving up. How much of the business are you forfeiting in exchange for the capital injection? I'd be mindful of a lot of these items that will come up in term sheets, such as, are you maintaining control of the board of directors? If you're giving up control, then you could actually wind up being kicked out of the very business that you had requested an investment by the people that you actually requested the investment from. Other things of that nature is to understand if distributions are going to be mandatory or discretionary. If they're discretionary, it allows you to ensure that you can keep additional capital available for the business. And this can wind up being crucial for the company's success, especially if you're not planning for another raise for a long time, or if you wind up having trouble procuring an additional raise. And then I'd say, understand everything with respect to stock options, equity, and what happens in the event that there's a potential purchaser or another investor wants to come into the business. So you never want to wind up in a situation where you're seeing your ownership significantly diluted by the next round of investment, or you wind up in a scenario where your whole investment or exit strategy, rather, is rebuffed because the terms weren't properly agreed to or understood at the onset of the VC relationship. So I guess, overall, when you're deciding whether or not to take on an investment, I think you need to look at the term sheet that you're going to be signing and really have a very clear understanding from A to Z about what's in there and what it means. And, the last thing I'll say on that is that it is true that, if you sign a memorandum of understanding, there are certain documents that aren't fully binding, but some things, even in those term sheets, really are. So you need to be prepared. For example, if you enter into an agreement where you're giving the VC the sole authority to be the only one to negotiate with you during this period, you better be pretty certain you want to work with that company and that you can handle the possible scenario whereby they wind up pulling out of the investment and you've just wasted 3 months of attempting to get to a deal and you weren't able to talk to third parties. So things like that, those types of clauses are binding and enforceable. So those are the types of things you want to be mindful of, knowing that term sheet inside out.
No, that's a good point. We're going to take a pause and to open any questions that the audience may have that could be directed at either one of us on the panel. Any thoughts that you may have, any questions that you may have, the topics that we didn't consider that you want to ask Mathias, myself, or Buck, Ross. So just take a couple of minutes, think about your questions. You could use the raised hand feature, or you could send your comment via chat, and I will read that to the panelists. If not, we do have some other questions. And so maybe we're going to ask some other questions while you're thinking of that. We want to make sure that as the audience and the participants, that you get an opportunity to raise some questions that you have on, and thinking about this subject or this topic is very important. Maybe you are in the process of raising funds or know someone who is, and you may have some questions, or you're in a startup, some things that you're concerned about in general, as you have an opportunity to raise those questions, and you could do so anonymously as well. Ross, you have a thought that you?
Yeah, you know what for Mathias that I was just thinking about. Mathias, have you ever sought investments from the United States? And have you run into any certain pitfalls through that process?
There were plenty of investors from the US as well, and we were definitely considering some of them. We even got an offer to be acquired the other day from US. All the time, and we're considering that every time it's up in the air. But right now, we're probably not going to raise for a little while. But it's something I would say to every founder. Now, you mentioned as well that think about the equity and where you stand. I would add a little bit to that. Think about where you stand after another investment and another, because if you're first going in raising, chances are that you're going to raise again. And I can say now that I know exactly the percentages I can offer up, or the amount of shares I can offer up for the next 2 or 3 times without still losing control. And I was very thoughtful in finding shareholders or investors that were willing to play that game with me and believed in me and the team's vision for now, and not trying to take control. Because there were definitely people that would like that, and they weren't the right ones for us, right? So now we know that we can raise on a much bigger level and still maintain control in the team here. So yeah,
that's excellent. While we're still waiting for some questions, I want to kind of raise some other thoughts, and this is to Buck. Buck, why is governance an important part of a company journey? To understand where governance fits in, because some companies, some fintechs don't account for it, and therefore run into trouble down the line. So any thought that you want to give with regards to the importance of governance?
Sure. In fact, I mean, it is something that I keep talking every day. So most of you are tired of hearing that, but let me say that again, because I never tire of it. You know, the governance word seems very big, and typically your reaction is that, oh, governance is something when we are big, when we have got a board of directors and, you know, all that stuff, only then we do governance. But that's not true at all. Whether you call it governance, whether you call it basic controls on your operations, whether you call it due diligence, you can call it what you like. But governance is absolutely important from day one of your business, from the time you think about your product, from the time you think of your, you know, what you want to actually do. Because product governance is where it begins. But at the end of the day, control of the company, like the financial control that Mathias just referred to, but not just financial and operational, but also the, you know, control over your technology, control your privacy, security, that is now so critical to your customers. And you cannot achieve that. You know, most people today, including very large organizations, they are doing governance one regulation at a time. So there is a large team of people work 4 months feverishly to achieve PCI compliance. And then another team achieves SOX compliance, and then another team achieves SOC compliance, and it just goes on. And it's too expensive. You can't keep up with that, no matter whether you are a 2-people startup or whether you're a company with a 2,000 people compliance department. It's the same story. So if you adopt a good governance framework, like I always help people adopt the US government NIST for risk management and COBIT for, you know, governance overall. A lot of good tools are available, and they are available almost at no cost. Adopting them from day one. And adopting does not mean that you do all of that from day one, but you have got a clear roadmap as to how you will be expanding your controls to make sure that as you grow, you don't lose control on any aspect of your operation.
Excellent. Here's a question that comes from the panelists, from the audience participants, and I'm going to ask the question, but I would like the panel to give a response. So we're going to start with Mathias. And here's the question. And it comes, and here I'm going to quote it. It says, I'm curious to hear more about the barriers that prevent startups from creating a marketing footprint early on. I'm a communications consultant who specializes in working with tech-based and science-based companies, and I'm trying to learn how best to help innovators get a clear, compelling message out to their target audiences or audience. Great question. So let's start with, let's kind of round robin it. Mathias, would you like to start with your thoughts?
Yeah, sure. And it's a good question. I think it's something we have been struggling a lot with, both while we're racing and explaining to our customers what we were. So for us, we've explained, like we had this vision and we have had a lot of trouble explaining it to the world. And it's something we're constantly working on still. So like, there's probably barriers of not having the know-how. I'm just a founder. I have no marketing experience ever on creating any of this, and we didn't really have the finance to go out and hire a good consultant for it, or anybody in the company. So we were working on what we thought was best, and there is definitely a gap. I think there's a lot of people trying to help, and we've been really good at using funding to find consultants that could guide us in the right way of different things, and we're constantly doing it still. But yeah, it's something we've actually struggled a lot with. I don't know how we can like break down those barriers. Besides funding for like really good consultants that can do it. Now we're starting to have a marketing team that knows what they're doing with everything and have the previous life experiences to build that up and talk about what we are and communicate with the customers much better than I ever could. But it's something I think a lot of founders struggle with explaining what they have in their head of a vision. And I found myself, I could never explain it in 2 minutes. Like it took me half an hour and most investors don't want to listen for half an hour to really understand what we are. They don't have that time. So I found that the investors that was right for us were like, so what did you do then? And what happened if we do that and that? So for me, it's something we can, like there's many startup founders and companies that could get a lot of support with. There's definitely barriers still.
Yeah, so sounds like we need to do a webinar topic just around that. So look for that as a completely different topic that we can explore. Great question. And so briefly, Ross and Buck, do you want to have any thoughts that you may have around that, just briefly, because we know that we're coming to the top of the hour. We want to.
Yeah, we are running out of time, but I'll quickly try to add a couple of sentences. In fact, Dawn is making a very important point in the question itself, that she's working for companies specialized in tech-based and science-based solutions. So I think this is where the problem is the most concentrated, because oftentimes technocrats or high-end, science kind of brains, they look down upon sales and marketing quite often. Let us be honest about it. And they feel that that's something that, product peddlers do. We don't have to do it because our solution is so brilliant. So that is one big mindset issue that we need to address.
Yeah, absolutely.
I'm sorry, I don't mean to hurt anybody, but I want to get very feeling. And the second thing is, when we talk about startups, we say, oh, 10% succeed, 90% fail, and why that happens. In my mind, the definition is fairly clear, that 10% is who first spend time communicating with the world, understanding what problem is there in the world, who has that problem, and what solution I can develop. And the remaining 90% are people who have got a solution, and then they start looking for a problem. Right? Because they have got a solution and they hope that somebody has got a problem that this solution can solve, and that doesn't work.
No, I remember we tested out very early on a quick fun story. When I had the idea originally for Oliver POS and the way we're doing things, I posted in a specialized group on Facebook. We just wrote, hey, we're a startup, we've tried this, would this be of any interest? And we've only been working on a couple of months on it or something, right? And we had 1,000 checkouts that very day on our trying to check out on our website. It was down. We actually didn't anticipate any traffic from it. I just wanted to validate the idea. But 1,000 people tried to check out that day. And then we started working on, okay, there's something here. Let's try and figure out further what we can do to fix that problem.
No, these are excellent questions. We're coming to the top of the hour. So we really want, as we conclude, we really want to thank everybody for participating. Mathias, we really thank you as our guest today. BFSI Tech Talks continues to provide information in the industry. We want to invite everybody to stay very close connected to your social media and the BFSI Tech Talks website, which is we'll make sure that everybody's aware of that, and I'll follow up to you. And again, thank you. There's one last question. Great insights. Thanks for bringing together, Mathias, and all the best with growing your business. That's some congratulations to you. Really appreciate the feedback. And what makes these webinars really special is the audience. So we thank you for being here and participating. We know that there are many things that you could do today, but you took an hour out of your day to be with us, and we are very humbled and grateful for the interaction that we're able to have and your input, and also to the panel. Thank you very, very much for your information, and we look forward to doing this again in the future. Thank you, everyone, and have a wonderful, wonderful day.
Thank you, everyone. Thank you, everyone. Thanks, Matthias. Thanks, everyone. Have a great afternoon, all of you.
Yes, you too.